a very brief recap, we are looking at something called personal investment planning. And the definition, if you can call it that, of personal investment planning is to do two things. One is to be aware of the objectives of investment. The second is to implement a plan to attain those objectives. So the main focus of personal investment planning is always on the objectives. And when we talk about objectives, there are just four: to increase wealth and not just income, to earn the maximum possible tax efficient return, to maintain the highest possible liquidity in investments, and to ensure the safety of investments. When we dealt with the tax efficiency, I presented two very simple tools: the post-tax rate and the break-even rate. And even if you don't want two, just one is enough, the post-tax rate. Viewing the bottom line rather than the top line. Not viewing what is printed on a, for example, fixed deposit receipt certificate. But applying the tax rate which you are subjected to and then getting a net return. Then we moved on to liquidity, we moved on to safety. And when we concluded our last session, we looked at four simple risk management tools available to all investors free of charge that could be implemented. And we almost finished looking at the first risk management tool of diversification. When we ended the session, we possibly ended with these 2 or 3 slides which I will just go through to refresh our memories on our memory about diversification. Diversification is so important that one of the investing giants of the last century, John Templeton, he says that the only investors who shouldn't diversify are those who are right 100% of the time. So if you're God, you need not diversify. But if you're anything other than God, then diversification would be the starting point in investing. Jason Zweig makes an equally powerful statement: to keep investing from decaying into gambling, you must diversify. If you even spend half a minute analyzing this particular saying, what message he is trying to convey is that any undiversified investment is a gamble. If you do not diversify, you cannot call it investment. It is a mere gamble. It is speculation. And Burton Malkiel, the investor who's wise diversifies. We started our whole discussion about risk with this slide from Warren Buffett. Risk comes from not knowing what you are doing. Not knowing what I am doing is ignorance. So risk comes from ignorance. And once again, Warren Buffett, diversification is a protection against ignorance. So these two slides beautifully put into perspective the role of diversification in risk management. Risk is ignorance. Diversification protects you against ignorance. Frank Armstrong, a certified financial planner in the United States, he says this, because this is a very important context. Today, I will be repeatedly returning to a theme called variance or volatility. This is as good a slide as any to introduce the theme of volatility. It is very important for investors to understand that expected rate of return does not fall as a result of diversification. Only the variation around the expected rate of return falls, and variation is risk. If you do not understand this saying here, do not worry, because we are going to speak quite a bit about diversification in today's, about volatility or variance, variation as he calls it here. Volatility, something happened to the Chinese economy, or we thought it happened to the Chinese economy a few months back. There was such a big fluctuation in the market. Then we had Britain leaving the EU, Brexit. Once again, a huge fluctuation. And something else, some terrorist attacks. any amount of reasons why stock prices will either go up or go down. Any amount of thoroughly useless explanations to justify a daily or weekly or half monthly change in stock prices. What we have not understood is two things. One is that variation or volatility has absolutely no role to play in a long-term investment. The second is, for a genuine investor, not a speculator, for a genuine investor, volatility is your best friend. So volatility is something to be embraced and welcomed, not to be shunned, not to be run away from. If nothing is going to be volatile, we might put all our money in bank deposits. There is no need to seek any other avenues of investment at all. In fact, a lot of investors ask me from time to time, with the kind of speeding up that we are having of life, all instant messaging, everybody online, crises happening more and more often, computers in control sometimes of stock market trading, pre-programmed trades. If it falls this much, buy so much. If it goes that much, sell that much. Almost no human intervention. Then the algorithmic trading and the speed trading that we have, all these things. Isn't it riskier for investors? According to me, it is not riskier for investors. Because for investors, volatility is not risk. Volatility is something to be capitalized on. Therefore, I very definitely look for more and more uncertainty, more and more volatility. Because it is your best friend if you know how to exploit it and how to profit from it. This is the message that he is trying to convey here. We will speak more about it as we go along. While diversification is the best thing an investor can do to reduce portfolio risk, a dumb investment is always a dumb investment. I know that if there is a friendly neighborhood finance, private finance company, not regulated by anyone, but it is offering me 22% interest on a 3-year deposit. I know that it's a dumb investment. I know if I put my money there, I may get interest for a few months. But I am almost certain of losing my capital before long. Now I have read about diversification. I have got 10 lakhs to invest. I am definitely not going to put 10 lakhs in that neighborhood finance company. What am I going to do? As per the principle of diversification, I am now going to identify 10 such financial companies and put 1 lakh rupees in each of those financial companies. So what I am going to do is, I know it's a dumb investment. I am now diversifying across a dumb investment spectrum. This is foolishness. It is absolutely true that all 10 finance companies may not collapse together. That I agree. But when we talk about a dumb investment, there is a very high probability that a sufficient number out of my 10 finance companies will collapse over a reasonably short period of time to cause me serious loss. So diversification should be across standard investments. A dumb investment is always a dumb investment, and no diversification strategy, however good it is, can prevent risk of loss in a totally dumb investment. In the great financial institutions, financial educational institutions of the United States, especially the Chicago University, for some time at least, when you entered the finance section or the finance classes, there used to be a board with this written there. And it is nothing but, there is no such thing as a free lunch. Or as the Americans say, there ain't no such thing as a free lunch. Turnstile, somebody calls it. This is what the finance professors always teach you. If something looks too good to be true, 22% interest, it looks too good to be true, it is too good to be true. It is dangerous. You are not likely to profit from it. And this is what is constantly told to students, there is no such thing as a free lunch. And in the investment world, believe me, it is absolutely correct. If somebody is wooing you with discounts, with kickbacks, with some incentives paid to you in cash, you can be absolutely sure that the product, the financial product or the financial investment strategy that they are trying to sell is an absolutely horrid strategy from your point of view, from the investor's point of view. There is no such thing as a free lunch. But the closest thing that you can get to a free lunch is diversification. Because without having to pay anything, by sensible diversification, you can vastly reduce risk. We talk about diversification. There is one higher form of diversification, and that is called asset allocation. We'll come to the difference between the two, but first we'll look at this. Asset allocation is diversification across non-correlated or poorly correlated asset classes. To give you one or two examples. Non-correlated asset classes, where there is a fundamental difference in the very definition of an asset. An equity share, a stock, represents an ownership interest in a business. When you buy a stock, you are not lending money to the company. You are purchasing a very, very tiny stake in the ownership of that company. You are a part owner. When you invest in a government bond, you may call it a government bond, or if you are investing in a bank, you may call it a bank fixed deposit. But what you are doing is, you are lending money in the case of a government bond to the government, in the case of a bank deposit to the bank. Now there is no ownership interest. It is a lender-borrower equation. Look at the fundamental difference between the two bases of these two asset classes. One is an investment that has an ownership, the other has a lender-borrower interest. Fundamental difference. Owning versus lending is totally different. So, when you diversify across these kind of classes, you are now moving from diversification up to asset allocation, which is probably the highest form of diversification. Non-correlated, something that can have no relation at all where its price movements are concerned. You can have real estate, you can have stocks, you can have bonds. Real estate, stocks, bonds. There can be times when by some luck, real estate market is high, the stock market is high, bonds values are also high. There can be other times where they totally move of their own accord. You can have a low real estate market, a high stock market, something like we have today. Real estate market is in the doldrums. Stock market is not at its highest, but it is relatively high. It's hardly about 8% or so below its peak, which is definitely relatively high. You can have interest rates that were high, started coming down. When we say non-correlated, we are not looking at perfect non-correlation. We are looking at asset classes whose prices need not move together. In fact, there is a far greater probability that they will move differently from each other. Let me give you an example of a perfectly non-correlated asset class. Take gold, bullion, although strictly not an investment. For a moment, we will consider that it is an investment. If there is real bad news, war for example, need not be where India is involved, it can be somewhere else, Middle East, somewhere else, and the news about war breaks out, what is going to happen? You can be almost certain that at least for a short period, there will be a serious fall in the stock market. And you can be dead certain that at the same time, there will be an upsurge in gold prices. In bad times or when bad news breaks out, gold and stocks are perfectly non-correlated. One goes, they do not have no relation to each other. In fact, they have an opposite relation. One goes down, other goes up. When money pours into the stock market, when everything is looking good, when the economy is looking good, you will find many times gold being sold, money being transferred to the stock market, as a result of which the gold prices start edging lower, stock prices start edging higher. There are times when both gold and the stock market can move together. But in the bad times, you can be sure that the two are perfectly non-correlated. What is the difference between asset allocation and diversification? Asset allocation is choosing different, preferably non-correlated asset classes such as bonds, equity and real estate. Diversification is choosing various investments within an asset class. For example, various sectors and stocks in an equity portfolio. So I am now only considering equity. Although I am very fond of banking, I don't want to put all my money in banking. So I am going to diversify, first across sectors, something in banking, something in other financial institutions, something in pharmaceuticals, something in software, something in vehicles, automobiles. When I am doing this kind of restructuring within the equity asset class, it is diversification. But when I am taking equity, real estate, bullion, bonds, it is asset allocation. And asset allocation is nothing new. This is a very humbling thing for all of us to learn. We use all these terms. They are a lot of jargon. But if you go back, asset allocation is something that has always been there. People who lived thousands of years before us also had grasped it. There is a Jewish holy book called the Talmud. It was written between these years. So at least it can be anything from 3,000 years to less than 2,000 years. During that period, various writers contributed to that book. But in that book, there was a famous writer, rabbi. A rabbi is a sort of a religious teacher or religious leader. Rabbi Isaac, or Itzhak, as they call it in Israel. What he said is, let every man divide his money into 3 parts and invest a third in land, a third in business, and a third let him keep in reserve. Look at the asset allocation here. A third in land. Today we will call it real estate. A third in business. Those days there were no companies. So it was your own business. But today, even if you are not cut out for business, you can invest in other people's business through the medium of the stock market. So in today's translation, it would be 1/3 real estate, 1/3 stocks. Let him keep in reserve. Those days there was no inflation because John Maynard Keynes was several centuries or millennium away. So everything was in the form of gold. What they meant was keep it in precious metals or something that was, the precious metals itself was a currency those days, which could be exchanged for determined value. So keep it in that kind of currency. Or today we would say keep it in liquid assets like liquid mutual funds, short-term bank deposits, short-term government bonds. So if we translate this, we can allocate assets going by that wisdom. 1/3 in real estate, 1/3 in the stock market, 1/3 in a variety of different bonds or keep it at hand. If you reflect upon this even today, if somebody comes to you, you do not want to go deep into his case. You just want to give him some basic common sense advice. Even today, believe me, this is a superbly good investment strategy. A superbly good investment strategy. Meets growth. Growth I've got 2/3. At hand, liquid I've got 1/3. So I can very easily rebalance, I can very easily allocate or reallocate as and when needed. My fresh investments that come in, I can just put into these 3 asset classes. So, after our many centuries, decades of very learned professors and other people going deeper and deeper and deeper into investment, the conclusion that we have come to is that the best form of investment for any common investor today is asset allocation. And this has already been said maybe 2,500 to 3,000 years back. So many times we have to realize we are not as smart as we think we are. What are the normal assets or investments that a normal person needs, a common investor needs to meet all investment objectives? The best answer probably comes from Professor Burton Malkiel, author of an investment classic called A Random Walk Down Wall Street, But he's got another smaller book. Of course, this is the 11th revised edition. There was another smaller book in which he has given these asset classes for a normal investor. First is cash. I don't mean in currency. It could be like a savings account, current account, liquid mutual fund, all these kind of things. Bonds. We are talking about a little longer term. 2-year, 3-year, 5-year fixed deposits. 3-year, 5-year bonds. We are talking about that. Common stocks and real estate. Virtually what that Talmud says, but translated to our modern environment. And this is more than enough. This is more than enough for the common investor. As we progress, investors will be distracted, virtually blinded by a number of new fads, alternative investment funds, investing in art, investing in antiques, investing in old wine bottles, antiques and vintage wines, this collection, that collection, vintage cars perhaps. All these kind of fads will come. When you put them under a scanner, when you apply the principles of investment to them, you will find several glaring faults. For example, when you talk about stamp collections, coin collections, they have no universal appeal. There is no stock exchange on which you can trade them at the press of a button. You have to find someone who has an interest in that particular area. And that person has to buy it of you. Many times the price quoted may not be a fair price or your expected price. The only way you can raise your price when you want to sell is if there is a perfect market condition, which means a large number of buyers and sellers, which means when we go back to personal investment planning, high liquidity. So when you go into alternative investments, the first principle you are damaging there or going against is the principle of liquidity. So these kind of alternative investment funds will come, all fads. One day people will lose and suddenly all that fad will go. It's already wearing thin. So be careful of this. Whether you're advisors or investors, all you need is these 4 asset classes. Absolutely more than enough. Actually just 3 asset classes. Except that cash refers to a very short term, very liquid. Bonds are a little longer term, but both are debt oriented securities. Jason Zweig, he says, anything is possible. And the unexpected is inevitable. Proceed accordingly. Anything is possible. What you think is this is not going to happen, it will happen. Proceed accordingly. And when you say proceed accordingly, it means diversify. That is a protection. That is a protection against the unexpected happening. The beautiful saying to drive home the point of diversification.